You're at a car dealership finishing the financing paperwork. The rate is already approved. The loan terms are basically set. Then one last form appears, and the finance manager asks you to confirm your income. He says it's standard. It helps the bank complete your profile. You give the number, it seems harmless. A few weeks later, your credit card limit increases. Not long after, the mail starts. Balance transfer offers, personal loan pre-approvals, upgrade invitations. The timing feels almost personalized, like the system quietly moved you into a different category. Most people assume the bank asked for income to make sure you can handle the account responsibly. But that's not really what the number is doing. Your income isn't only a qualification detail. It's a pricing and targeting signal, and it helps determine how much credit you'll receive, what rates you're offered, how often you're marketed to, and how profitable you're expected to be over time. The system isn't reacting to you as a person. It's reacting to a profile. So the real question isn't, why do they want my income? It's, what changes after they have it? In this video, we'll look at how income data feeds lending algorithms, why lenders often request more information than they need just to approve you, and how being intentional about optional disclosures can affect your long-term financial position without lying and without breaking any rules, because financial institutions don't run on goodwill. They run on incentives. And the clearest place to see that is in a message almost everyone has seen, but rarely questions: the small prompt that appears when you log in to make a payment. Let's start there. The serve you better illusion. You log into your credit card account to pay a bill, and before you can move forward, a message appears. Update your annual income to help us serve you better. It looks harmless, friendly wording, a small form. Your old number is already filled in, but serve you better doesn't mean what it sounds like. Banks already see your spending patterns, payment timing, balances, and credit utilization. They know whether you pay in full or carry interest. They know if your balance spikes in December or if you revolve $3,000 every month. They don't need your income to understand behavior. They want it to sharpen predictions. When you enter a new income number, internal models immediately adjust. Your profile is rescored. Your projected lifetime value changes. If your income jumped from $80,000 to $120,000, that's not just a personal milestone. It's a signal of profitability. Higher earning capacity means higher potential balances, higher tolerance for annual fees, and higher cross-sell probability. Notice the contrast. The message feels like customer care. The system treats it as monetizable data. Fresh information is more valuable than old information. A 3-year-old income figure is less predictive. An updated one reactivates segmentation logic. That's why the pop-ups return every few months. The real issue isn't whether banks collect data. It's understanding why they collect this specific number and how it changes the way they categorize you. Before deciding what to share, you first need to know what's actually required and what isn't. Required versus optional, what you actually owe them. When you apply for a mortgage, income verification is not optional. Lenders must document your ability to repay. That means pay stubs, tax returns, and sometimes 2 years of history. After 2008, underwriting tightened for a reason. Auto loans usually require income disclosure too, though verification varies. Larger loan amounts mean stricter checks. Credit cards are different. At account opening, you're typically asked to state your income. Regulations require issuers to assess the ability to pay, but here's the nuance. In most cases, they rely on what you report. They are not pulling your tax return automatically. They are not accessing payroll records. It's largely stated income. Now fast forward 6 months or 2 years. You log in and see a message asking you to update your income. That request is usually voluntary. There's no legal penalty for closing the pop-up. Your card won't shut down. Your credit score won't drop. The message simply reappears later. This is where people get confused. Required at application does not mean required forever. A loan contract is one thing. A mid-relationship data refresh is another. And that distinction matters, because once you understand what you truly owe them, you can start thinking less about compliance and more about strategy. To see why strategy matters, you need to understand how banks actually use that number behind the scenes. The 3 hidden layers of bank decisions. When you give a bank your income, it doesn't flow into one decision. It feeds 3 different systems running at the same time. Layer 1 is risk underwriting. This is the obvious one. Can you repay? What's the probability of default? Income helps estimate debt-to-income ratios and stress capacity. If you're carrying $20,000 in revolving balances, and report $60,000 in income. That profile looks different from $160,000. Layer 2 is pricing optimization. This is where things get interesting. Banks don't just ask, will this person default? They also ask, what will this person tolerate? Two customers with identical credit scores may receive different promotional structures based on predicted sensitivity. Higher income can signal lower urgency to shop for a 2% rate difference. That subtle shift changes expected profitability. Layer 3 is marketing segmentation. Income influences what shows up in your app, your mailbox, and even pre-approved loan offers. Premium travel cards with $550 annual fees don't get pushed to everyone. Neither do aggressive balance transfer offers. You're categorized, quietly. These layers don't operate in isolation. They reinforce each other. A higher income can justify a higher limit, which increases spending capacity, which increases projected lifetime value. And once you see that income touches risk, pricing, and marketing all at once, the next question becomes unavoidable. How does that play out in something as simple as your credit limit? Credit limits, flexibility, or financial trap. Income directly influences your credit limit. Report $150,000 instead of $70,000. And the system is far more comfortable extending a $25,000 line instead of $8,000. On paper, that looks like trust. In practice, it changes behavior. Here's the part most people miss. A higher limit can actually help your credit score. If you carry a $2,000 balance on a $5,000 limit, that's 40% utilization. On a $25,000 limit, it's just 8%. Lower utilization typically supports a stronger score. That's the upside. But there's another side. When available credit expands, spending often expands with it. Studies on revolving credit behavior consistently show that access influences usage. A $30,000 ceiling doesn't just sit there quietly. It becomes an option. And options get exercised, especially during travel, holidays, or unexpected expenses. Banks understand this pattern well. Larger limits increase the potential interest base. Even if you usually pay in full, one rough quarter can turn flexibility into balance carry. So a higher limit is neither good nor bad. It's leverage. And leverage magnifies discipline or magnifies mistakes. Which leads to the next layer. Once your income signals capacity, how does that affect what you're charged? Not just how much you can borrow. Ability to pay pricing versus risk-based pricing. Most people assume interest rates are based purely on risk. Higher credit score, lower risk, lower APR. That's partly true, but pricing models don't stop there. Risk-based pricing asks, will this person default? Ability to pay pricing asks, how much margin can this person absorb? Those are different questions. Imagine two customers with the same 760 credit score. Both pay on time. Both carry similar balances. One reports $75,000 in income. The other reports $190,000. The higher earner may be less sensitive to a 2-point rate difference or a $95 annual fee versus $0, not because they're careless, but because the relative impact feels smaller. Banks study rate sensitivity closely. Customers who rarely transfer balances or refinance are statistically less likely to leave over pricing. Income becomes one signal in predicting that behavior. This doesn't mean high earners always get worse rates. Many promotional APRs are standardized. But across products, personal loans, premium cards, add-on services, profitability modeling goes beyond default probability. The key distinction is subtle. Risk determines if you qualify. Pricing determines how much they expect to earn from you. And once your income suggests a higher lifetime value, pricing is only one piece. The next shift often shows up in how aggressively you're marketed to and what tier you're quietly moved into. Income and customer tier classification. The moment you update your income, you're not just adjusting a number, you're adjusting your tier. Banks group customers by projected lifetime value. That estimate blends income, spending patterns, balances, and product usage. A higher declared income increases expected profitability. And once that projection rises, your experience changes. Log into your account and notice what's promoted. Premium travel cards with $550 annual fees. Personal loans are pre-filled with higher amounts. Investment management invitations. These aren't random banners. They're calibrated to income brackets and predicted acceptance rates. At the same time, lower income profiles are often funneled toward balance transfers, installment plans, or short-term liquidity products. And the targeting is precise because the segmentation is precise. Fresh income data refreshes that classification. Updated information signals new earning capacity, which can trigger more aggressive outreach. A stagnant income figure, especially one that's several years old, is less predictive. Models prefer current data. That's why update requests keep returning. Here's the subtle shift. The bank doesn't need to change your interest rate to change your relationship. It can simply change what it puts in front of you. And once classification drives offers, the next question becomes even more important. What happens when economic conditions tighten? And those same tiers are reassessed under stress. Income during economic stress. When the economy tightens, banks shift from growth mode to defense mode. That's when income data becomes more than a marketing tool. It becomes a risk filter. During the early months of the pandemic, millions of credit card limits were reduced across major issuers. Even customers who had never missed a payment saw lines cut. Those decisions weren't personal. They were algorithmic portfolio adjustments. Income plays a role in those reviews. A higher reported income can signal stronger repayment capacity, which may protect a limit from being reduced. But here's the twist. That same higher income can also justify maintaining higher exposure, which increases the bank's expected interest revenue if balances rise. On the other side, lower reported income may trigger preemptive credit line reductions during uncertain periods, not because of bad behavior, but because models forecast thinner buffers. In stressed environments, banks don't evaluate customers one by one. They evaluate segments. Income helps define those segments. The important detail is this. Income doesn't operate alone. It interacts with utilization, payment history, and overall account age, which raises a crucial question. If income influences internal models, what actually determines your credit score? And how separate are those systems really? Behavior versus stated income. What actually matters? Income feels important, but when it comes to your credit score, it's not even in the formula. Scoring models focus on behavior. Payment history carries the heaviest weight. Missed payments hurt fast. On-time payments build steadily over the years. Utilization is another major factor. Keeping revolving balances below roughly 30%, and ideally under 10%, tends to support stronger scores. Length of credit history and account mix also matter. Notice what's missing: salary, annual income, raises. None of those numbers is directly reported to credit bureaus. That's where people get confused. Banks use income internally. Credit bureaus score behavior externally. Those are separate systems. You could double your income tomorrow, and your score wouldn't move an inch unless your borrowing behavior changed. This separation creates leverage. If you consistently pay on time, keep balances controlled, and avoid excessive new applications, your profile strengthens regardless of what income figure sits in a bank's internal file. In other words, your habits speak louder than your salary. And once you understand that distinction, the real question shifts. It's no longer, should I tell them? It becomes, when does updating my income actually work in my favor? And when does it simply sharpen their models? Strategic disclosure. When updating helps or hurts. There are moments when updating your income works in your favor. If you're applying for a new credit card and want a higher starting limit, a higher income can improve approval odds. If you're requesting a manual review for a line increase, documented growth can support that case. Lenders look at debt-to-income ratios when extending larger credit. In those situations, transparency helps you. The problem is reflex disclosure. Updating income just because a pop-up asks is different from updating with intent. If you're not seeking more credit, not applying for a loan, and not renegotiating terms, the immediate benefit to you may be minimal. The benefit to the bank, however, is clearer. Fresh data improves segmentation and cross-sell accuracy. There's also risk on both sides, and overstating income is illegal and can trigger serious consequences. Understating income too aggressively can limit future flexibility or flag inconsistencies if spending patterns far exceed reported earnings. Systems notice anomalies. So this isn't about secrecy, it's about timing. Share information when it advances your position. Decline optional updates when they serve no purpose for you. That mindset leads naturally to a broader principle, one that extends beyond income fields and credit cards. It's about how much information you voluntarily hand over in any financial relationship. Data minimization as a long-term strategy. Every financial institution runs on data. The more precise the data, the more precise the pricing, targeting, and profitability modeling. That's not personal. It's structural. Data minimization simply means this: provide what's required. Pause before providing what's optional. If a mortgage application requires 2 years of tax returns, you submit them. If a credit card pop-up asks for a mid-cycle income refresh and you're not seeking anything, you're allowed to close it. Precision benefits the model. Uncertainty often benefits you. When systems have less fresh information, they rely more heavily on observable behavior. Payment history, utilization, longevity. Those are variables you directly control. This approach doesn't mean hiding. It means reducing unnecessary inputs into optimization engines designed to forecast your profitability. The fewer voluntary data points you feed into those systems, the harder it becomes to fine-tune extraction strategies. There's a quiet shift that happens when you see financial relationships this way. You stop reacting to every prompt. You start evaluating incentives. And that shift isn't just about banks. It applies to any platform, lender, or service that frames data collection as improving your experience. The real improvement begins when you understand who benefits most from the information you share. Key takeaways. Income disclosure isn't about honesty versus secrecy. It's about understanding structure. Banks use income in internal models for risk, pricing, and segmentation, but your credit score is built mostly on behavior. That separation matters. When you update income without a clear objective, you improve the precision of systems designed to optimize profitability. When you update strategically during applications, negotiations, or limit requests, you shift leverage back in your direction. The real advantage isn't hiding information. It's recognizing incentives. Institutions benefit from clarity and predictability. You benefit from intentionality. If you start viewing financial prompts not as obligations, but as choices, your entire posture changes. And once you see that dynamic here, you'll start noticing it in other financial decisions too.